Have you ever seen a vibrant, bustling market suddenly seize up, where everyone wants to sell but no one is willing to buy at a reasonable price? Liquidity loss plays a profoundly critical role in market crashes, often acting as a powerful amplifier that can transform a mere market correction into a full-blown financial crisis. The core mechanism is straightforward. Liquidity refers to how easily an asset can be bought or sold without significantly affecting its price. When liquidity dries up, it means there are few willing buyers for assets, or that those buyers demand a substantial discount. This creates a situation where sellers, often facing margin calls or urgent funding needs, are forced to dump assets at ever lower prices. The bid-ask spread, which is the difference between the highest price a buyer will pay and the lowest price a seller will accept, widens dramatically, signaling deep market distress and making transactions prohibitively expensive. Market makers, who typically facilitate trading, also step back due to increased risk, further exacerbating the problem. Understanding these dynamics can help you interpret market signals during periods of stress. For instance, a sharp increase in trading volume accompanied by rapidly falling prices and widening bid-ask spreads can indicate a significant loss of liquidity. This is not just a theoretical concept, but a very real condition that can accelerate downward price movements, creating a feedback loop where falling prices lead to more forced selling, and thus even lower prices. Historically, episodes like the 1987 Black Monday crash and the 2008 global financial crisis vividly demonstrate this principle. During these events, the ability to buy and sell common assets quickly and at fair prices evaporated, trapping investors and institutions in a spiraling decline. Central banks often intervene as lenders of last resort during such times to restore confidence and inject liquidity into the system, aiming to break this vicious cycle. Grasping the concept of liquidity loss illuminates how fragile market confidence can be and why efficient functioning markets, relying so heavily on a continuous flow of capital and willing participants. It reveals that a lack of buyers can be just as devastating as a lack of demand for underlying assets, underscoring the interconnected nature of financial stability.